Hello, my name's Tim Gregory. I'm the Senior Fund Manager at Vermeer Investment Management in London, and I'm just here to update you on some thoughts about how the US results season and the US stock market's been performing in recent weeks. As we know, stocks have been having a tremendous run and the results season has been very good indeed in the main. But there have been one or two stocks who've had a little bit disappointing results, and one company perhaps to mention is Cisco Systems, which has been going through a major transformation in recent years, moving to a much more software subscription-based model. But as it does so, there have been some bumpy quarters. And although the company reported results that were pretty much in line with expectations, they did guide to a pretty weak revenue outlook. And I think this is symptomatic of a global economy which continues to show weakness in discretionary spend and the manufacturing industry and some areas of IT software spending, particularly those relating to 5G spending in the future and the network companies. And this is an important thing for markets to focus on, because there has been a significant rally in recent weeks in the more industry sensitive and economically sensitive areas of the market, clearly anticipating that the trade war will be resolved and that the interest rate narrative will continue to be positive. And the way markets have moved clearly anticipates a much stronger performance from here from a number of companies. And as the Cisco results revealed last night, it may be that some distance before we actually see some real recovery, and there could be some disappointments ahead for other companies whose stocks have rallied very strongly, but as yet their results haven't come through to reflect that improvement in the economy. And that is something that we'll be watching very closely over the months ahead. And as we finish that part of the results season, which relates to the industrials and the financials and the IT software related companies, we move more into the retail companies starting to report their results. And we've seen one or two already coming through, and they've been pretty decent. But next week that intensifies, and it'll be interesting to see whether the consumer, which so far has held up so resiliently and helped buoy the US economy, is continuing to do as well as he has done in recent years. Clearly, interest rates remain supportive, and although the Fed is now on hold, there's no reason to expect any change upward in interest rate policy anytime soon. So with employment pretty full, the consumer should continue to perform well. But it will be interesting to see how stocks do on the back of that as they report their results in the coming weeks. One other company that reported results quite recently was Disney. The focus of the attention there, far less on the parks business and the film business, but much more on ESPN Plus and the very exciting new DCC Disney Plus streaming business, which has also launched in recent days and showed a staggering 10 million subscribers literally signing up on day one, which is probably way better than Disney themselves had expected, and certainly better than the market was anticipating. Strong reaction to Disney shares, and simultaneously, of course, a negative reaction to the shares of Netflix, with the market continuing to fret that if Disney Plus does well, Netflix cannot do well. This is clearly not a certain thing, and we will remain to see just how Netflix's business performs as we go through the months as Disney grows its subscriber base further, and how other businesses like AT&T with HBO Plus launch also coming through next year, how their businesses perform. So a lot going on in that space, and that's going to be a very interesting area of the market going forward. Thanks very much for your time.